The Flood Disaster Protection Act represents one area of compliance that can appear straightforward in some regards, but can also be a cumbersome area for institutions to manage, especially when dealing with complex or unique situations. At the core of flood compliance, the financial industry is aware of the general prohibition from making, increasing, extending, or renewing a loan secured by improved real estate or a mobile home located in a special flood hazard area in a community participating in the National Flood Insurance Program, unless the property securing the loan is covered by flood insurance. To help their supervised institutions comply, the Federal Reserve, FDIC, Farm Credit Administration, NCUA, and the OCC have provided interagency Q&As regarding flood insurance, which were recently updated in May 2022. One of the significant topics addressed by the flood Q&As relates to forced placement procedures. Keep in mind that the Q&As do not represent regulatory changes. However, they contain guidance that will assist lenders in meeting their compliance responsibilities. So how do the flood Q&As address forced placement? Well, the May 2022 issuance contains 16 Q&As on the topic, which indicates that specific focused guidance on forced placement is needed. In this discussion, I wanted to share some highlights from the forced placement Q&As and provide more detailed discussion of Q&A forced placement 10, which I'll get to in a moment. First, at a high level, the forced placement Q&As provide a good background by clarifying that if a lender determines that collateral securing the loan is uninsured or underinsured, it must begin the forced placement process. That forced placement includes a required notification to the borrower that they must obtain flood insurance. If the borrower fails to obtain flood insurance within 45 days of the notification, then the lender must purchase flood insurance on the borrower's behalf at that time. One of the most significant forced placement Q&As is one that focuses on a forced placement process whereby a lender adds the forced place flood insurance premiums to the balance of a loan, which is a common occurrence in the industry. More specifically, Q&A forced placement 10 asks this question: does capitalizing the flood insurance premium into the outstanding principal balance constitute a triggering event, an increase that would trigger the applicability of flood insurance regulatory requirements? This is a great question, and the need for official guidance in this area was needed. As the response first indicates, there are various methods that a lender might use to charge a borrower for forced place insurance, such as capitalizing the premium and fees into the outstanding principal balance, adding the premium and fees to a separate account, advancing funds from the escrow account to pay for the insurance, or billing the borrower directly for the premiums and fees of the forced placed insurance policy. So, in determining whether these actions constitute a triggering event, an increase, let's discuss each one individually and hear what the agencies have to say. First, premium and fees capitalized into the outstanding principal balance. If the lender's loan contract includes a provision permitting the lender to advance funds to pay for flood insurance premiums as additional debt to be secured by the building, such as an advancement, would be considered part of the loan. As such, the capitalization of the premiums and fees into the outstanding principal balance is not considered an increase in the loan amount and thus would not be considered a triggering event. If, however, there is no explicit provision permitting this type of advancement of funds in the loan contract, the capitalization of premiums and fees into the borrower's outstanding principal balance would be considered an increase in the loan amount and therefore is considered a triggering event because no advancement of funds was contemplated as part of the loan. Second, premium and fees added to a separate account. If the lender accounts for and tracks the amount owed on the forced place flood insurance premiums and fees in a separate account, this approach does not result in an increase in the loan balance and therefore is not considered a triggering event. Third, premium and fees advance from the borrower's escrow account. If the lender's loan contract with the borrower permits the lender to advance the premiums and fees for the forced place flood insurance from the borrower's escrow account, this approach does not increase the outstanding principal balance and is not considered a triggering event. And fourth, premium and fees billed directly to the borrower. If the lender bills the borrower directly for the cost of the forced placed flood insurance, this approach does not increase the outstanding principal balance and is not considered a triggering event. In closing, you should consider how your current flood-related forced placement procedures address these types of actions. In connection with this, it will be important to review your loan contracts to see whether they contain a provision that permits you to advance funds to pay for those flood insurance premiums. And if your loan contracts do not include such provisions, you might consider discussing this with your attorney about including such provisions in future contracts. Having clear, documented procedures related to your flood insurance forced placement process helps staff better understand their compliance responsibilities. If you have any questions or would like additional information about flood requirements and forced placement, please feel free to reach out to us. Thank you.